Hi there, Stephanie Kammerman here live at the Las Vegas Money Show 2018. And look who I am here with. I'm so excited. Gene Inger, IngerLetter.com, also the pioneer for financial television, which morphed into CNBC.
Which, of course, I started when I was only a kid in daycare.
Yeah, so
that's a long time ago.
You have been in this business for a long time.
A long time ago.
Yes.
We started, we had 5 cities, LA, San Francisco, Chicago, Miami, New York.
Right.
But when CNBC started, with all good friendship, because we merged into CNBC, but basically that's like if I owned a hardware store and Home Depot opens next door, they win.
Right.
And so we merged into CNBC, and I sort of disengaged at some point to Florida, and I do my 4 times a day comments, sort of a blog style at night at IngerLetter.com, and then for those that are interested in day trading, I do several other comments, one of which I just did moments ago here at the show.
Yeah, but let's just talk about how you got started into this business.
Well, at age 13, my father, who didn't like to play stocks, he wanted to control business himself. He had met Bob Six, who was once married to Ethel Merman, and then the Audrey sisters. He gave me basically 100 shares for my birthday of Continental Airlines at $6 a share. It went to 6. By the time I was 16, it went to 72. I sold half, and I went to Europe, and I put another portion in TWA at 11, which I sold for 44, and I put a portion into my first Corvette. And teenage kids saw dollar signs.
Yeah. So how about teenage kids, because we probably have some watching right now, what would you tell them to invest in?
You know what, that's a great question, because most of the people here are anything but millennials.
Right.
And I'm telling the millennials, I'll use 2 stocks as an example.
Right.
The millennials should do something other than annuities, which I'm not a big fan of. They should have a portion of assets they trade because they enjoy it, many of them, aside from money they have with professional money managers or various ETFs, which I think there's a danger there, and there's a danger in option writing in an extended market, which is, these are the things I talk about in my service. But I would buy, I'll use one simple stock.
Give us a stock.
AT&T.
And they know, they all have a cell phone.
At 40, I didn't like it. I liked it in 09 and the 20s. I like it more now at 32. People say, oh, it's a sell signal. It went below this line in that channel. No, it has a 6% dividend. They're not going to cut the dividend.
Wow, it's an amazing
That's
dividend.
better than treasury bills, and certainly better than gold, which pays no interest or dividends, which I'm not a big fan of, even though I was once ranked the #1 gold timer, only because I recommended it at 600 and said sell it at 1400 or 1600. And it went a little higher. I recommended silver at 17 and I sold at 37. It went to 47.
I mean, you didn't peg the top?
No. In a perfect world, you would be completely in cash at the exact top. And in a perfect world, you'd be completely invested at the exact bottom. But it's not that world, so you scale in and scale out. I have a popular saying of mine, which I learned when I sold a stock that doubled, and then it doubled again after I sold it, which is, if you double or triple your money in a stock, sell half and hope you're wrong.
Yes.
Hope you're wrong. Scale out. So then the rest goes now.
No exititis.
You asked about the millennial. The young person.
Wait, when we come back, we're going to talk more about the millennials, because I really think this is such a powerful subject. There's a lot of young kids out there.
One stock is my pick of the year. I'll tell you the name now and the details when we come back.
Okay, go ahead.
LightPath.
More to. Stay tuned.
Stay tuned.